Interest rates obviously have been top of mind for many, and they are going to stay higher for longer. This is a trend that we've been talking about for a long time. I think the markets are finally catching up with that. First and foremost, the Fed has won the credibility battle. So the Fed was late to raise rates. There was concerns that they were going to be asleep at the wheel. And so what you're looking at here is inflation expectations, what the market believed inflation would average over the next 10 years. And you can see it had hovered in that 2 to 2.5% for a long time. That's where the Fed had committed and said they wanted to keep inflation was in that 2 to 2.5% range. It started to inch up close to 3%. So the market was telling us that inflation was going to average almost 3% over the next 10 years. And that's when the Fed became much more aggressive and much more active and raised interest rates quickly. And you can see then the market lowered their expectations. At the same time, while inflation is trending downward, it is only happening slowly. And there are a number of factors that are going to keep inflation higher for longer. Here is how the market expectations for interest rates have changed. What you're looking at is the implied federal funds rate now versus where it was essentially a year ago. And it's about 150 basis points higher than where it was a year ago. And here's another kind of view of that. You can see where the market had anticipated it to be even just a few months ago, where we were looking at three interest rate cuts, about 75 basis point cuts by the end of the year. Now the market is pricing in more like 25 basis point cuts, and nothing really materializing until fall. So interest rates stay higher for longer. I think that has implications on a number of things. Driving insight 4 is that low rates will eventually open up doors for strategic capital investment. But I think the other thing that happens here is that once the Fed does move, and I think they do move in the fall, they signal to the market that they are in the part of the cycle where they will start to cut rates. And they have already made it clear that if things were to deteriorate quickly, they would be more aggressive and more active. But I think what this does more than anything, more than making investments more attractive, is it removes uncertainty and it creates some better clarity about the Fed's direction. Now, I think one of the things the Fed is hesitant about is they are worried that there is a lot of capital sitting on the sidelines waiting for the Fed to cut rates, and that if they do cut rates too early, too quickly, then they will see an upswing in demand that will drive inflation higher. So I think they're hoping to move once they feel like that motivation has dissipated.